Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really glad that you could be here. We are live here in the studio in Silicon Valley. We are here to help you improve your retirement, especially in the area of finances. We do that by answering your questions. You can send your questions in now to the email address on the screen, Ask Tom, talkmoneywithtom.com. You can put them into the chat. You can send the questions during the week. Anything you'd like. We try to answer questions that came up in our strategy sessions with our clients. We work on three main areas: asset management, retirement planning, and tax planning. So we'll try to focus all this information there, hoping to educate you in an area that there isn't a lot of education available. And so we created this channel. You can subscribe to the channel if you'd like, peruse all of our different videos that we have on there, hit the little bell button if you want to get notified when we do some new content. And then, of course, if you want to, you can just meet with Ethan and I, like 30 minutes phone video conference. You go to the website. There's a link here on the channel, and there's a book appointment button up in the corner. It looks just like that on the website, and you can choose a time that works for you. And Ethan and I can answer your questions, one-on-one, specifically, things that you might have. But feel free to send those questions in now. We can try to answer them live here on the air. Really enjoy doing this show for everybody, and hopefully everybody gets something today that they can use, for their own benefit. I do like to start off the show every week with a situation. Oh, look at that. We don't have our share working. Interesting. Let me try this. Hang on a second. Nope, not working. All right.
Do you guys share?
So the this is live. You can tell. So what do we have to do to get the share working? Because I've got all the charts to show.
Do you want to go technical? Good.
Okay. Come back. All right, we're back. Let's see if this works. Hey, there we go. This is actually a really sophisticated set. This is a really fun show for us to do. We're sitting inside. I'll actually show you since we've got the view here. This is what we actually are sitting in here, is this green screen room. We have very sophisticated computers and cameras and everything to kind of make this happen. Sometimes they don't work. So what I want to start off the show, of course, as normal, with a summary of kind of what I saw happening this week. And here's the S&P 500 since the beginning of last year. That was our peak last year on the 4th of January. Kind of had that red line there that showed the trend. And one of the things you look for is which way is the primary trend. And one of the things we look at is, are the peaks higher or lower? In this particular case, the peaks have been lower all the way through last year, kind of connected by that red line. And so our current signals are, our stock market signal is green. Why don't we show those, Ryan? And there we go. So the way that this works is that we have kind of this process in the background, an algorithm that we've created to kind of take a look at multiple different inputs. And we have a fast and a slow signal. So what that really means is that kind of we're looking at things that are happening on a shorter term basis or a longer term basis. And we use the fast signals to really operate some of our transitions and trades that we do inside of our IRAs, Roth IRAs, those type of things. We don't have to worry about tax consequences in those scenarios. We use our slower, more longer term signals for our taxable accounts. We don't want to generate as many trades as possible. Historically, on a backtesting basis, fast has a better rate of return than slow. That's why we use that one in the IRAs, for example. Now, our bond market signals are currently yellow-green. Let me show the bond market signals. There we go. And so we've got a scenario here where a little bit of caution on the bond market here in the short term. And we've made some adjustments to the portfolio. And what we're doing there is we just essentially want to be in a scenario where we're a little bit shorter term, or inflation protection securities and those types of things. And so if it's green, both for bonds and stocks, we're fully invested. Sometimes we'll use things that have more motion than the market so we can maybe participate even greater on the upside. If it's yellow, we pull back and get more defensive. If it's red, we'll often get very defensive, sometimes even to the point of moving into, kind of T-bills and things like that. So just to kind of explain that. And so let me make this a little bigger so we can see this. And back to my concept about primary direction here, you can see now, since the bottom that we hit here in October, we had a high that came up right to the red line, and then we hit a second high that was higher for the first time. We hit another new high in this particular motion, and that's a big deal. And then we started back down. We've got below the red line, not too long ago here, and then we started up again. And so things we look for, like a checklist. We want to establish a new high that's higher than the previous. Did it? We want to get through the red line, the trend line. Yeah, we did that. We even held it again. We want, when we do fall back down and retrace, we don't want to go below the low that's right above my head, right? We held that, which is great. We want to get through the 200-day moving average. We did that. We want to see the 50-day moving average come up from underneath the 200-day moving average. That's called a golden cross, has a really good track record for predicting direction. That has happened and held. And then the next things we want to see now is we're about 1% away from establishing a third new high from that low in October. We're almost there. And looks like we might get there. So we'll see. So that's going to be what we're watching for next week, is how that plays out. Then I think maybe the last thing on my checklist is we really are in this giant range. If you look back to where we are now and go back, May of last year, we were at the same place. And so really 11 months we've gone sideways, but we got this huge range. So the last thing to say, we're now in a directional change, primary direction up. We're not sideways, which is pretty much where we are now. We're not down, is to break out of that range, which is about 4,300 and change, and that high that we hit back in August of last year. And so, we're not too far from that. We're at 4,100 and change now. So this is what's happening here. And so, of course, we're in the middle of all of this negative articles. Oh my gosh, I've never seen so many about how everything's going to fall apart in the banking system. And they might be right, but the market is going up. It's been going up since October. And you do have to pay attention, I think, personally, more to what the market is doing than what they're putting in the article. Right? I mean, somebody's making a projection. It might be somebody we really, think is very good about making projections. But the market is making a projection here that things are, looking good. Now, it's not always right, but it's more often right than the articles, in my opinion. Because right now it's about 10 to 1, negative to positive, which isn't completely unusual. In 2020, when the market was skyrocketing up, it's one of the greatest markets I've seen. There was a lot of negative articles all the way up. Negative sells, right?
Yep.
It gets more clicks. We could get much more views on this show if we talk doomsday constantly. And we try to, be somewhat balanced, but certainly actually skew to the positive side a little bit, just because of the fact that I want to offset some of the negative, especially with my clients. And so what we have here is this potential directional change that's going along. We do have to pay attention. The banking crisis seems to be behind us, but it really isn't, because the banks are probably going to be cutting back on their lending. Right? And that's a way of kind of contracting the economy in and of itself. There's concerns about this inflationary pressure on earnings themselves. Because, if you keep having your costs go up as a company, as long as you can keep to raising your prices, you're okay. But eventually that doesn't happen. There's a price elasticity that kind of hits a ceiling, and then your costs can still be going up, and all of a sudden your profits are starting to get squeezed.
When demand hits that point where they just don't want to pay anymore.
Yeah, exactly right. And I don't know that we've seen that dramatically yet, but we're starting to see it. Definitely. There's a lot of pent-up demand and a lot of money. People refinance. People got money from the government during the pandemic. The job market is still very hot, those type of things. So wages have been going up, not as fast as inflation, unfortunately, but going up. So households and businesses are in pretty good financial shape as a whole, right? So that's what's kind of driving on the demand side. And it really, the battle between, is that demand going to be enough to keep us out of a recession or at least a deep recession or not? Is the demand going to collapse in order for us to bring down inflation? Well, I'll call this inflation week, right? Because what we had from this week was a report on the CPI, right? And we'll cover that first. So CPI is a basket of goods that they look at to determine, how much did it grow, in this case, year over year. So we're looking at, essentially March of this year versus March of last year. And you can see there it's 4.99%. That's a pretty good trend. I'm showing the last 3 years.
Yep.
2 years it went from basically zero to peak out in July at 9.1%. Okay. And now we're kind of coming back down. So a lot of people ask me, when do you think it might get down? Inflation's really hard to tell. But on a pure pattern basis, it would be reasonable to expect it to get back down as fast as it went up. I don't see it collapsing, although that can happen, especially if the economy starts to fall apart. But took 2 years to get up, could take 2 years to get down, July of 2024. That actually sort of fits in with the statement of economic projection that the Fed puts out 4 times a year. They're looking at, that kind of end of first half 2024 to finally getting back down to this 2% rate. Now, keep in mind, the Fed talks 2%. They're not talking about CPI here. They're not talking about anything except for core PCE, which is already in the 4% range right now. And we'll be talking about that in a couple of weeks because that report's coming out at the very end of this month. It's very late. It'll come out for March. But the trend is good, right?
Yep.
This was a good report. Now, the problem with this basket includes food and energy, which the Federal Reserve, for the most part, ignores food and energy. Not always. They've made some comments sometimes, but generally speaking, they look at what's called core CPI. And so core CPI takes out food and energy. That pattern doesn't look quite as good.
A little bit more sticky.
Yeah. And so now it did peak out in September, so it's a lower, but it's not that kind of smooth dropping scenario. And the reason is because of what's in core is the things that we're starting to buy, services, rents, and those types of things are part of this. So, that was I'd say that was a negative for this week. It didn't drop as much. You can see it's actually have a little swale here recently.
Yeah, and you can see it's higher than actual CPI.
Yeah, that's right. And that's kind of interesting too. So that's one of the pieces. Now, the thing that came out yesterday that really drove the market was PPI, right?
Yep.
So this is a producer's price index, kind of wholesale prices. And that trend looks fantastic. It actually peaked out in March, not in July. So it peaked out earlier, and it's coming down really fast. And it's all the way down to 2.75%. Matter of fact, it actually was negative for the month over month, March of this year versus February of this year. And so that's a good thing. This is why the stock market is hanging in there and doing pretty well. We are seeing, I think, some trends overall in inflation that are pretty good. And so the expectations is that we would see, a quarter point increase on the next meeting, which would be May 2nd and 3rd, announced on the 3rd. And by then we'll have some more info. We'll know what the PCE inflation number is by the end of the month. But the market is betting on a quarter point increase right now. And, interestingly enough, the market is actually also betting on a decrease of interest rates by about 0.5% on the federal funds rate by the end of the year. So that's not what the Fed has said that they're going to do. It's not in their statement of economic projections. Their statement is they're going to go up one more and stay there, right? Yep. And that changes, but that was for their last one. And they're going to stay there all year. And so this is where there's been some disconnect between the market and the Federal Reserve. And that's somewhat the scary part because the market sees something and the market tends to be fairly accurate, more accurate than the Fed. And so if the Fed doesn't see the same things and then holds up rates too long, you could have a harder landing, recession-wise.
Can the market still do well by holding at 5.25?
Yes, it can actually. I mean, we had the greatest run in the stock market history in 5-year period was 1995 to 2000. I believe the Fed funds rate was in the 5 to 6% range for most of that run. And I'm just recalling this off the top of my head, but yes, definitely. There has to be some things going on that work. Now that was not a high inflationary time frame, so that's what's going to make it difficult. So that inflation kind of moderating the way it's doing, and I think direction is super important as far as that goes. So that's what's going on. I think things are better overall than they seem. If you read the articles, that can change. We'll change with it. We have our system of triggers, of fast and slow, stock, bond, etc., and we respond to these things. We have this debt ceiling issue that's coming up, right, that we'll have to deal with. There's things that we need to be aware of and to respond to. But I'm just trying to kind of push back a little bit on some of the things I'm seeing, in the articles as far as that goes, and really pay attention to what's happening to the price of the stock market. So I read all these articles too. You should also, if you're really interested, but make sure that you balance those out because, again, it's 10 to 1, right? Negative to positive. So if you read all the articles and you read 11 of them, you're going to have a pretty poor outlook on what's going on. That's not a balanced outlook, and that's going to make you, in my opinion, a worse investor, right? You need that kind of balance. You have to hunt for the positive. Find the negative quite easy. I think that's what we provide here, by the way, is some of that positive information. All right? Good. All right, so that's our summary. Let's get into the questions. What do we have for questions today?
I like your red, yellow, green light signals for your trading. Can you go into a little bit more detail on exactly what each mean and how do they change specifically? What triggers, going from a green to a yellow?
Okay, that's a good question. And we have pull up the visual here that we use for the signals. This is just a sample. So we have a stock market, right? Fast, slow. Bond market, fast, slow. So in this case, we have fast yellow for stock and slow green, and a green for fast on the bond and red slow, right? So what happens is, first of all, there's two different markets, stock and bond, right? And those are important. They're treated differently. Everything's related, in the end, right? I mean, it's kind of crazy how things can be related. However, we treat those as two separate universes. And then secondly is this fast versus slow, which is in both of them. And so a fast signal means that we're responding more to shorter term data, right? We're going to make more trades because of that. Historically, when we look back and back test our algorithm, we do have a better rate of return on the fast signal than the slow. But lots of trades to make that happen. So we don't want to do that outside of an IRA or a 401k or a Roth IRA or an annuity or something where we don't have to account for those trades.
Yeah.
Right?
Because when you do something too quickly with a taxable account, you're going to add more taxes and, that taxes could wipe out the actual profit.
Yeah, even if you're taking some losses, it's still kind of a pain, right? You got a lot of things to put on the tax return and those type of things. So that's where the slow signal comes in, looks at longer term data and moves slower as far as that goes. And so we'll make less trades, doesn't have the same rate of return that the fast does. Now, the difference in light color is important to us too, because green means go, right? We're looking at the market is moving. We want to get in there and we want to be at least at the level of the market in terms of the aggressiveness that we're taking, if not slightly higher, so that we can kind of really participate in that upside, right? And we want, if the market makes 10, we'd love to make 11, whatever it might be that happens. And so then we might get a yellow trigger, and yellow is just like it said, caution. We'll move into things that are more defensive, higher dividend paying stocks, utility stocks, those types of things, consumer staples, and our system kind of automatically identifies what's coming up to the top during those periods of times, and that's generally what it is. And for bonds, that would be shorter term bonds, inflation protection securities, those types of things that might come up. And then when we get a red signal, It depends on what happens, and we've got a combination, but it can lead us to basically going into T-bills with those holdings for that period of time. Now, this is a little controversial. Most people like that kind of buy and hold concept, but we specialize in retirement. A lot of our clients are already retired, and none of them want to go through something like the Great Depression, where the stock market dropped 86% and took 14 years to come back. Right? So we're trying to make some preservation here. We have people coming to us that like the system because they're worried about the debt ceiling argument. And what are you going to do? Well, our system will automatically trigger, and theoretically we could be in T-bills if there is a big collapse caused by the debt ceiling default or something crazy. I don't see that happening, but we're ready for whatever might happen. Actually, the things that tend to be the most dangerous and the most dramatic are the things we're actually not talking about. Right? We weren't talking about credit default swaps when Lehman Brothers failed. We are now, and that created a 30% stock market drop. Right? It's the things that we don't know about that are actually the most damaging to the stock market and possibly even the economy. But we're able to capture those because we're looking at the price of the stock market. So what drives these? Well, we have an algorithm that we are developing constantly. One thing about the stock market, it changes all the time. So you're always having to update your algorithm and challenge your parameters and such. And so we've created kind of an algorithm that goes behind the scenes and kind of chooses. And so right now you can see we're green on the stock, right? And in the bond, we are yellow-green, right? Currently right now too. So that's where we've got our data comes from, this whole process that we have behind the scenes. I'm not going to give all the details on how that works because it's really our proprietary,
You'd probably
secret
fall
sauce.
asleep if you weren't interested in it.
That's right. But it's a great question. Hopefully that helps. If you're looking at this, and I now post these on every daily video that we do, just keep in mind, if you see green and green, that's a good sign, right, for the stock market. If you see, the fast and the slow is kind of short term versus longer term, right? And so, look for those seagulls for yourself as far as that goes. But they've been very effective for us. Now, the key is to understand on any type of system like this, it doesn't have to work all the time. Matter of fact, our signals are often wrong. You get a little bit over 50% right is great. Even 50.7% is actually pretty awesome. But the way it really works is that when it's on, the market's falling, let's say, and you're sitting in T-bills, you're now gaining against the market dramatically. Or the opposite, the trend is up and you're green, and you're going and you're in. And you're maybe making a little bit more than the market on those upsides too. And so that's, on the other ones you can lose money and, cut your losses quickly and let your winners run is essentially the way that this system works. So right now we're getting a lot of churn. There's no doubt because there's these conflicting, pieces coming together. But eventually the trend will establish and will be off and running. So anyway, that's how that works. Great question. All right, what's the next question?
Why is the producer price index considered a leading indicator for the consumer price index?
Why is the PPI, the producer price index, it's a wholesale inflation, why is that considered a leading indicator? Well, let me pull up the charts again real quickly here for the, there we go. All right, so this is what we use this in the summary, right?
Yep.
Here's the 3-year chart for the consumer price index. Notice that it peaked in July, okay, and has started to come back down as far as that goes. Now, the next slide that I had in there was the producer price index. Notice that it peaked in March, right? Quite a few months ahead. Look at the producer price index now, coming down much more aggressively. And so that's why the market was up 1.3% yesterday on the S&P 500 because this report came out yesterday for last month. And so it makes some sense. I mean, there's a process of, how the goods get to us as far as that goes, right?
Yeah, when you conceptually think about it, if your manufacturer has to pay higher prices, they're going to pass it on to the customer. But if they can slowly cut their costs, they're going to probably hold their prices and not let them increase. And so if they're not increasing their pricing and still maintaining their profits, inflation comes down.
Yeah, exactly. And so yeah, I do find that interesting. The wholesale prices are going up. It's because although this looks like it's down, there's some confusion here. I run into with clients once in a while. Are you saying that food prices are going to go down? I haven't seen that happen. And no, that's deflation. That's a different story. What we're saying is that the price increases will slow down.
Yeah.
Yeah. And so what's happening on the wholesale sides is that, the price increases over the last year grew 2.75%, whereas the consumer's price, oops, sorry, wrong way. The consumer's price is up 4.99%, right?
Yeah.
And so the margins are actually growing inside the wholesale community at the moment. But competitive pressures are what eventually drive that. So that, again, it's a leading indicator. If the wholesale prices are coming down, you will eventually see in most markets that translate to the overall. Again, it's not that the prices are coming down. I'm sorry for saying that, but if the rate of change to the upside is slowing down, the rate of change to the upside on consumer prices will also slow down.
Mm-hmm.
Right? So, and again, the Federal Reserve is trying to get that back down to 2%. Right? So that's their target for core PCE. Is the big issue. So it's a great question, and it really is. It shows some knowledge of what's going on out there right now.
What are some possible effects of the OPEC Plus production cuts on the market?
Okay, so OPEC Plus is the oil producing cartel. I don't know what you want to call it. And then the plus means they've added some other countries. The big one, of course, is Russia. And so they meet on a regular basis, and they talk about how much they want to target barrels per day type of thing. And so just recently, they decided to cut back production. And when they cut back production of number of barrels of oil, theoretically, if the demand stays the same, the price of oil would go up, right?
Yep.
Sometimes they're cutting it back in falling demand, right? So that, then the price doesn't get affected. Like in 2020, they were cutting back production pretty drastically, but demand fell off the cliff because nobody was flying planes, nobody was driving anywhere for a while, that kind of thing.
Yeah, oil actually went negative.
And it actually went negative for a day, which is really wild, which just meant that it costs more to store it than to own it. So, but just recently, obviously, the price of oil has come up. It went up quite a bit during the initial portion of the invasion of Ukraine, and lots of concerns there because Russia at that point was producing 11% of the world's, oil as far as that goes. And so now you've got the scenario where they're trying to cut back. What they're trying to do is get the price back up, to a certain level. They're also, in their words, looking at the possibility of some recessionary pressures that are coming, and they're trying to prepare for that by not flooding the market with oil. If demand falls off a cliff and they keep their production at the same, the price comes down. So they don't want to go through that. They'd rather bring their production down in advance. I think it's actually sort of a political thing. They're trying to, put pressure on the world's economies here. So the question was, how does this impact the economy? It's kind of interesting. It depends. At certain levels, it really doesn't, right? There's like ranges that the oil prices can move around in, and it doesn't have a dramatic impact. When it gets quite a bit lower, that can be quite stimulative to the economy. Yeah. When it gets above that kind of range, that can be quite, restrictive to the economy. And the reason is because it's in everything. If you buy an apple at the store and it costs X amount more than it used to, part of that could be because of the energy required.
It costs X amount to get there.
Yeah, it's got to get there. They got to produce it. They got to pick it. There's labor involved, but energy is everywhere. It's in every product. It ends up, almost every product ends up on a train, a boat, a truck, right? You name it. So it's very important to the overall economy. It's also really hazardous in terms of inflation because it can rise the price of everything all at once really quickly, and the Federal Reserve really has no way of handling that. They're not a member of OPEC Plus, right? So what happens then, of course, they push the oil production down, price of oil comes up enough, and you could get what happened in the 70s, where we had that really oil shock, and the price went dramatically high, and the Federal Reserve then, and this is not just ours, but around the world, is having to raise rates to blunt demand in totality And that can be really, hazardous to an economy in total.
Yeah, and when you think about it, the oil prices for a crude barrel haven't increased that much.
No,
January they were in the 80s, and
right,
right now they're in the 80s, but
right.
they fell down into the 60s because of the Silicon Valley kind of banking crisis and
Yeah.
the recession
Yeah,
fears.
that's right. That's right. So a recession or fear of recession will drive down the price of oil because there'd be less need for it, theoretically. I think one of the big stories that's not being talked about enough maybe is the resurgence of China coming out of the zero COVID policy, really getting rolling again on a consumer basis, the traveling, again. And so I think they're the second largest economy in the world. Their energy consumption, I think we're number one. I think they're number two. I've heard that maybe we're back fourth, but very high consumer of energy,
Yep.
because of the production that they do. And so if they get rolling again, that would put more demand into the energy pipeline, right? Which could drive up the price. And if OPEC Plus is lowering the amount of supply, that could drive up the price. So, but we haven't seen a lot of evidence of that. And actually, at around this dollar a barrel, it's already kind of baked in. There was some fear that we were going to see like $260 a barrel.
Yeah.
And that would have been really, really tough to deal with after the Ukraine invasion started. And again, lots of articles out there, so many of them, lots of clicks probably on that $260 barrel oil article. Believe me, did not turn out to be true at all. Matter of fact, amazingly, Europe has done quite well through the winter and all the things that they had to deal with, even though they had such a high reliance upon Russia. So it was much better than people expected. Good. What's our next question?
What is a brokered certificate of deposit?
A brokered certificate of deposit. So just quickly, a CD, what's what we call it, short term, is you give money to a bank for a certain period of time, 3 months, 6 months, a year, 3 years. You can do, there's a 5 years, and they pay you a certain fixed interest rate.
Mhm.
At the end of the term, they give you back your money. So if you put in 10,000, you get back 10,000, and you got that whatever interest rate during that
Yep.
period of time, right? So that's just how they work. So a brokered CD is just purchased through a brokerage. Why don't you tell them how that works? This is something Eason kind of specializes
So
in.
it's a brokerage, or it's just basically someone else other than the bank. And so the idea is that the bank wants to expand their reach and they want to sell their CDs to more people. And so the idea is, okay, we'll use a third party, someone else to sell it for. And so they sell it, and then, for example, Citizen Bank is out in Boston and they want to sell, CDs to everyone in the country. So they go to TD, and TD says, okay, sure, we'll sell them to our clientele, and then they buy the CD. And so the idea is, with a brokered CD, you can buy from multiple banks, keep it in the same account, and you still have that FDIC protection for your CDs.
Yeah, that's what's kind of cool. All of these CDs are available. We can look them up and see what rates they're offering. So it's kind of like a competitive leaderboard in a way. Every one of those banks is FDIC insured. So every one of your deposits at every one of those banks has got the $250,000 protection. And you can get one statement with, say, $200,000 in each CD. So you're under the 250. You got 4 different banks on there, all coming through on one statement. And then, when they come due, you just find some more and you just keep them going. And, it's fairly simple as far as that goes.
The one thing is, unlike a regular CD, you could have your CD just keep allocating. If you do a brokered CD, you have to specify and redo that repurchase.
Yeah, you got to go back out. But one of the other weird things about a brokered CD versus a bank CD is the possible liquidity. So most bank CDs that I'm familiar with have liquidity. You can get out of them, but they usually charge you a penalty of some type. The most common penalty that I've seen is 3 months worth of interest. Mm-hmm. So, if you're in there for 6 months, you would lose half of that basically, because you lost 3 months worth of interest. With a brokered CD, you can sell them at any point in time. There's no problem with that. However, the value fluctuates day by day, depending on what's happening with interest rates. So if you bought a 5% one and everybody now is getting 4% ones, your 5% is actually appreciated in value. You could sell that and actually make money, put in 10,000, you get back 10,100 or, whatever it might be. However, it could be worth less also if the rates go the other way, and then you just wait for it to come due and you get back your 10,000. Or I'm making up the number 10,000. It could be any dollar amount. Probably should keep it under 250 in today's world. But nonetheless, that's the concept. And we've been getting a lot of interest in these, and we've set up quite a few of them. I think it's a neat way of handling. For those people who have more than 250 sitting in a bank right now. You might want to be a little bit careful with that here in this environment, in general, all the time.
Yeah, and another thing you can do, another thing to watch out for is callable and non-callable CDs. So a lot of times when you see brokered CDs, they'll have a little bit higher rates for callable CDs. Essentially, a callable CD is, the bank says, I don't want to pay this interest rate anymore, so I'm just going to say I'm going to pay out whatever you have to pay out, and the CD is gone now.
Yeah, that's right. There's usually a little bit of a premium on the callable, like you said. So, it's a lot like a bond. Basically, it's just through a bank, and as a matter of fact, the same mechanisms that a bond reacts to, a CD react to. It's very fascinating. And you got the FDIC insurance on top of that. So it's it's kind of a neat bond in that regards, as far as that goes. So, great question. Great question.
It just allows you to reach a little bit further than your normal pool of banks that you would have in your local area.
Yep. Good. All right. What's our next question?
I got a windfall. My wife and I are debating between investing it or paying down our mortgage, which is at 3.5%. We're both in our mid-50s.
Okay, so we've got a 3.5% mortgage. We're missing some data that would be really useful in that question, just from my perspectives. Number one is, how much is the mortgage versus the windfall? Mm-hmm. So in other words, I have $1 million mortgage and I got a $100,000 windfall, right? Versus I have a $50,000 mortgage and a $100,000 windfall, right? Two big differences. Because if I take the $100,000 and put it in against that $1 million mortgage, I still owe $900. My payment doesn't change if it's a fixed mortgage. Mm-hmm. Sounds like it might be if it's 3.5, right? Because right now it'd be higher than that if it was variable. And so I'm still going to make the same payment. Now, I'll be paying more towards principal. I'll pay it off faster, but I'm still a really long ways away from paying that off on a normal basis. I still owe $900,000 on that
you're
mortgage.
only going to save on that interest.
Yeah, and that's good, and there's something to be said for that. On the other hand, let's go the other direction. I'm just going to take the whole thing and invest it. Right?
Yep.
Average rate of return for the stock market is 11% a year. Never seems to actually make 11. It makes some extremely high or low numbers, but that's the average. I hang in there. I go through that process, but I've got this fluctuation to deal with, right? And so I kind of have this guaranteed. I know I'm going to pay off X, and I feel safe doing that inside my mortgage. And I've got this situation where I don't know what I'm going to get in the stock market, and so. If it's a small mortgage below the windfall, I might pay it off.
Yeah.
Right? Because now I know that payment just disappeared. Right? Boof. I've
now got flexibility.
Yeah, I got positive cash flow. In the other scenario where I got $1 million mortgage and $100,000 windfall, my cash flow hasn't changed. I'm still making the same payment. I have to. I can't change that. I could theoretically go do it. I could refinance it, but you can't do that today. You're going to get 6%. So you're looking at 3.5 versus 11 for the stock market. You're looking at something guaranteed with paying off the mortgage, right? Versus something not. So I split the difference.
Yep.
That's what I'd look at. I'd split the difference. I'd put $50,000 toward the mortgage and $50,000 into investments. I think that's the best way to go because there's pros and cons that I think equal out fairly well for me. Not for everybody. I mean, some people just really don't believe in the stock market, period. They've had bad experience, and that's fine. So I think you really have to pay attention to your own belief system because you have to live within that belief system. I happen to believe in the stock market long term, and I think that's the way to go, and I've certainly seen my clients do very well with that. And that's why I kind of would do the 50-50 split between those. Pay some off the mortgage, good. Now the payment's still the same, but I'm paying more principal, right? Less interest in total. Put some in the stock market. Hopefully I average that 11% over the long term and I can always sell that at some point in the future and put down more into the mortgage if I want to, that kind of thing. So
Yeah, and you have to think about this. It's purely numbers you can think about really easily, but it's an emotional decision too, and you're gonna have to be living with each other. So you kind of want to make a compromise that works for both of you.
Right.
So you don't want to be black and white about it. You want to have a little bit more gray to it.
yeah, I mean, personally, like if somebody came to me and said, "What's the best way to pay down my mortgage, faster?" I've got this excess money that I want to spend, not just like a windfall, but every month I've got extra money. I'd probably, again, depends on who it is, but for me, I'd probably do the same thing. I'd put half of that extra money towards the mortgage itself and half into a brokerage account where I'm buying the S&P 500 or something, and then I would let, the two might meet. So in other words, I'm paying down the mortgage, it's, to some level, and then my brokerage account is growing with my additions and hopefully the growth in the market. And then once they meet, maybe I sell the brokerage account, I pay taxes on the gains, and I use that to then get rid of the mortgage. So again, I'm splitting the difference between that, especially if it's a long ways off, still going to take me, even if I'm paying it off faster, still going to take me 10 years to do so. There's only been a couple 10-year periods in the stock market where there hasn't been made money, right? So, and most of the times it's done quite well. So anyway, that makes a difference. But it's a great question. It's come up before. We've heard that type of scenario quite a few times. Congratulations on the windfall.
Yep.
All right, we have time for maybe one more.
Should I put off having a vacation due to inflation and market conditions?
Should I? Oh boy, some more data we need there too, just like the last question.
Yeah.
So, how much is the vacation versus how much money you have?
Yeah.
Right, $2,000 vacation for somebody who's a multimillionaire.
Take it.
Probably wouldn't ask the question, to be honest.
Yeah.
They're probably going to do it. $2,000 versus somebody who has $4,000.
Yeah.
So you get the point. There is some differential there for how much the vacation costs versus how much money you have or income you have, or however you look at your money as far as that goes. Actually, I'll share the the screen that we were using here again real quickly. There we go. So this is the consumer price index. So you're waiting for inflation to come down. All right, it's coming down. Yeah,
But you're
slowly.
gonna wait 2 years for a vacation.
It took 2 years to get up. That would be great. The Fed seems to think it's going to take 2 years to get down. So you're going to look till summer of 2024. That's not terrible, but you just missed out on a year and a quarter of possible travel that you could have done.
The thing is, you don't get time back.
No, you don't get time back, and there's no guarantee. It could be cheaper now
Yeah.
than it is by then. You don't know. I mean, so I probably, again, assuming that it isn't a massive stretch to you financially, which is it's really another story and another answer, is just, to kind of go with what's happening here. Inflation is growing at a slower rate right now, but prices are still going up, right? I mean, in this case, the overall basket grew 5% over the last year.
Yeah.
So, theoretically, that vacation could be at least 5% higher next year, if it stayed at the same level.
Yeah, and if you're really feeling kind of, getting some anxiety about it, maybe you change it up. Maybe you're planning an international trip. Well, let's keep it domestic. There's other ways you can kind of cut that expense without really, you still want that benefit of that vacation on your mental health.
Yeah. I think overall, inflation actually does drive some consumer behavior, but it actually tends to drive it the opposite way of what the question was asked, because people tend to spend sooner than later, because if I spend later, it's going to cost more, right? And so, I mean, there's stories of these hyperinflation countries where people are running to buy stuff, because it's going up 100% a year and these crazy things. And so, again, that vacation could cost more next year than it does now. So, that's why I'd probably be considering it now also. All right, well, that's the conclusion of our show. Thank you for bearing with us during our technical difficulties here at the beginning. Really enjoyed today's show, though. I think there was some great questions, some really good content. Hopefully everybody learned something. Send in your questions. During the week here, we'd love to get these, love to answer these. We're here to help you. This is, a live show we do every Friday. So you can also subscribe to our channel. Again, continue your education that way. Hit the bell button to get notified. And then lastly, of course, if you want to, you can book an appointment with Ethan and I. Just go to our website, got the book appointment button there. We'd be happy to talk with you. So look forward to seeing you again next week. And of course, I'll still be doing my daily videos on what's going on Monday through Thursday for 2-3 minute videos that I do on kind of a summary of what I saw happening for the stock market. So look forward to seeing you then. Thank you very much.